There may be good news for markets ahead. Despite global economic concerns and the 10-year yield hovering around its lowest level in 15 months, Barclays analysts predict that investors will be driven out of safety and into risk assets once the pessimism over global growth calms down. Joining us is Prudential Financial Chief Market Strategist Quincy Krosby. Quincy, what's your take on this Barclays report? Because, on the one hand, you look at it and say, well, maybe there is a bit of an overreaction in the markets, but also when you look at the fundamental numbers, it does point to a broader global slowdown.
Well, it does. The question is it beginning to stabilize? That's the key. If China stabilizes, if Europe stabilizes, and if the U.S. does not deteriorate any further, I think what's going to happen is the market will have a catalyst to move higher. But that said, one of the obstacles coming up is the earnings report. And that's going to be very important because we know that the earnings are going to be weaker. There's no doubt about that. But the picture that we need to see is coming from the top line, the revenue growth, because that is a picture of demand. It's a picture of where are the orders coming from and where are they not coming from. So if you take that and couple it with the fact that the market is right now fully priced at 16 times versus coming out of the December downturn at 13, then the question is, how much more do we have to hear from companies in terms of guidance? Because that's what's going to be important. We know it's going to be weak, but we need to hear what they're saying. Then perhaps you'll have a catalyst to move higher. But overall, this is a market that has been very selective. It's a market that has hedged itself. One part of the market is saying, we like cloud, we like technology, but guess what? We've got some consumer staples. We've got utilities. All of that suggests a market that is hedging itself in many ways.
So when you talk about revenue growth pointing to demand, are there any particular sectors where your expectations are high going into the earnings season?
Well, I could say which ones are lower going into the earnings. Actually, technology is actually come in and said, we see less demand. We see less demand. The question is, the market understands that, look, we're looking back. What we need to see is where we're headed. And where we're headed is clearly, just as the Barclays commentary says, if things stabilize, that's a big if. So China needs to not just stabilize, but it needs to start showing signs of growth. Clearly, as the world's second largest economy, they have the fiscal stimulus, the monetary stimulus. We expect to see even more coming out in terms of cutting rates. To start seeing them come out of this downturn. Europe, you see what the European Central Bank is prepared to do. Clearly, they know that things are slow.
They're going back into an easing stance.
Yeah, absolutely. They were actually, September was supposed to be a first rate hike. That has just been pushed way off into the future. And in the U.S., the Fed is holding off, and the Fed funds futures market is saying the first move that we see is not a rate hike, but a rate cut. So all of these just need to change a bit. And even, by the way, if the market sells off a bit, that would actually be positive to move forward.
There's a lot of investors who are watching this saying, well, what do we make of this inversion of the yield curve? We've heard the history of the recession risk, but how should they be reading this? You say you have to respect the curve, but don't overreact to what's happening.
Well, exactly, because if it is just intermittent and every so often you get an inversion, that's fine. You have to pay attention. It's been the 10-year and the 3-month. That's the favorite of many of the central banks, or Federal Reserve banks, rather, in their research units. They say that has the highest positive correlation between where the economy is and where it's headed. However, you hear about the 10 and the 2, and that is tight. I mean, it is very close, very, very close to possibly an inversion, but it has not inverted. But there are other aspects, key metrics, which are still very strong. Over in the credit market, yields are nice and tight. The credit default swap market, which is a very important guide to especially high yield junk bonds, if they get expensive, you know that the market is saying we're really beginning to worry. That's not there yet. In terms of unemployment claims, still nicely low and manageable. We need to see a broader swath of metrics saying we see a major slowdown.
Okay, so keep things in perspective. That's the takeaway.
Yeah, exactly.
Quincy, great to have you on today. Quincy Krosby joining me here on set.